Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. If you're enjoying the show and getting some great value for your own investing goals, let us hear about it. Give us some honest feedback with a rating and review. It helps us, but it also helps other listeners find this show for their own investing goals. If you want to find off-market multifamily deals, but you don't want to waste time cold calling people, you don't want to go through brokers and pocket listings, and you don't want to harass owners, this is a conversation you want to check out. Today, we sit down with Christian Osgood, and he talks about how he was able to scale his portfolio in multifamily by building strong, authentic relationships with owners, using seller financing and creative deal structures to get deals done. Hey, this is a great conversation filled with a bunch of actionable insights to help you scale and grow your multifamily portfolio. So be sure to check out today's episode of Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Let's welcome to the show, Christian Osgood.
Hey. Good to see you, man. Thanks for having me on. This is going to be fun.
Absolutely. Christian, it's great to have you on as well, man. Excited for our conversation today. I went over your background at a extremely high level. Why don't you take 2 minutes and fill in some of those gaps?
All right. Well, started in Seattle, Washington. My original goal was to retire my wife from teaching. She used to love her job. Then teaching in Seattle during 2019, 2020, teaching kindergartners over Zoom. Not super fun. Came back. She got pushed down on the playground, broke her lower back, and the school tried to cover it up. It was a just absolute nightmare. So we went from, hey, I that time I'd bought 2 rentals in a 8-year sales career. I did the Dave Ramsey method: save, buy rentals, move forward. Each one cash flowed $1,000 a month. So I had $24,000 a year of duplex income, and I had a tiny little house outside of Seattle. Had a mortgage of $2,000. I got to a cool place in 8 years of working where my real estate was paying for my real estate. That's as far as I got. I was on the train of like, hey, let's move forward. The goal being, let's make good financial decisions and have more money. It was a undefined, not specific, not that aggressive goal. Your real estate paying for your real estate over a house and 2 duplexes. Cool place to be. I don't want to downplay that. It's a good thing to do. Within a year of wanting to retire my wife, we retired my wife. I bought another 80-something units in that first year, starting with a seller finance 38-plex. I had at the time $10,000-something in my bank account, and we ended up buying millions and millions and millions of dollars of real estate. Today, my portfolio is a little over 300 units, about to close on a 76 unit, so it'll be a little bit over 400 units. Have a resort, property management company, education company. We have scaled immensely over really from the end of 2020 to today. So really over the last 5 years, we have built financial freedom, which has been amazing. And a lot of other people have copied some of the strategies that we've used to do this. The one goal, and this will be the main thing for me, every deal has to answer 2 questions. You have to figure out how to buy it and how to never lose it. That is that sounds a lot like buy and hold. That is a reason, but that is the underwriting criteria that matters. We need to buy things that pay us day one and continue to pay us forever. I don't want to buy a deal twice. So every deal for me is a deal when we can buy it and it cash flows day one. It cash flows through the entire deal, and I do not have to rely on a future sale of that deal to make the deal work. I have to be able to hold it forever. If I can do that, that's where the creativity comes in. That is a goal for me. The rest of it, and I'm sure we'll get into this in the podcast. What does the seller need? That is a goal for me. Every time I close a deal, my income goes up. That is really the only rule. And I have done that over today, 23 transactions, 24 transactions. That is the whole basis of it. Everything we do is just based on those two simple questions. How do I buy it? How do I never lose it?
I love it. I love it. Christian, you gave some great insights right on your background. Just playing it back, you had a little bit of a sales career, started investing in some rentals, following that Dave Ramsey method, right? No debt. You're buying these properties cash with those duplexes. But you really saw an opportunity where you wanted to retire your wife from her job, right? She was working as a teacher, kindergarten teacher, had an issue coming up with the school. And that really was the push to say, you know what, we've got to figure out how to scale this thing. You next moved on to a 38 unit seller finance deal. Fast forward today, you've done over 300 units. So you continue to scale. You got the education business. You're helping other people do the same. And your two principles I love: for every deal, you want to know, how do I buy it? And how do I never lose it?
Yep.
And that's a great mentality to have when it comes to real estate in general, because we know that's the thing that stops people, right? We know these are cash flowing assets, or they can be. We know these typically go up in value over time with the appreciation. We know that there's depreciation, which you can also take advantage of from a tax standpoint. And over the long haul, this is a really, really solid investment. The challenge that people run into is treating it almost like a flip, where they're buying it and they're trying to do something and sell it in 2 years or 1 year or 3 years. And maybe they're not putting in the right strategies where they can hold on to it until they're ready to depart from that asset. So let's back it up, right? Because I think the inflection point in your journey was, you talked about the situation with your wife.
Yep.
You talked about that next deal being a 38 unit seller financed opportunity. Talk about going from buying the duplex to the 38 unit, and what did you need to do to make that happen?
So that deal was, this is an interesting deal. It had been on market at the same price for 12 years. So this
Wow.
isn't like, it's not like this
Wow.
was some super hidden secret deal. This was out there for anyone to do. Granted, if you bought it 12 years ago for $2 million, you would have got destroyed. That's just way too much. However, fast forward to, very end of 2021. Fast forward to 2021, Washington State, Central Washington, 38 one and two bed units for $2 million is an incredible price. Like, on a price per unit basis. Obviously, real estate's not just valued on price per unit, but you look at it, it's like, wow, that is really inexpensive for what you're buying. Why? Well, they had a failed septic drain field and their collections were absolutely terrible, which means the property was not conventionally bankable. A bank would not give you a loan to buy that property. It did not have the income to support that. It lost money operating day one, which I will get to this because I said every deal needs the cash flow day one. We actually were able to figure this out. But the way that we had originally put it together, those units did not make money. It was a cap rate of -1, which means it actually cost more just to own the building, pay the utilities, pay your operating expenses, maintenance, repairs. If you went through taxes, insurance, maintenance, repairs, you would lose money with the rent they're bringing in. We were able to cash flow that deal day one by getting barely creative on the seller finance. What no one had done in 12 years is we sat down with the owners and we said, my goal is to retire my wife. So I'm like, we need cash flow. The deal did not cash flow. No one has ever bought it. We sat down and said, okay, here's what we need. We need a way to get paid every single month from this. And we believe that there's huge upside in this deal, but it's going to be really hard to get there. When I'm looking at the deal, that's what I need. They went, okay, well, really what we want to do is we want to retire on $10,000 a month. They owed like $275,000 on the deal. Like, we need to cover our existing debt. We're more than happy to sell our finance, but your down payment's going to need to be greater than what we owe on the property. Well, that makes sense. That's how you're able to sell our finance. So down payment of 300, price of 2 million. They want to get to $10,000 a month. The property at the time was not yielding that. It was on the rent roll, but they weren't collecting that. There's problems that needed to be fixed at the property. And when I took a look at it, it's like, these are problems that we can fix. No one has bought this deal because the people who can afford to buy a $2 million 38 unit and have the experience are buying easier properties. The people who have the money to buy this in cash or do this in any other way are like, there's an easier project to do. Your mom and pop owners, people like me at the time, are too busy looking at duplexes to open their mind to larger opportunities. I saw that one and I was like, if we stabilize, this is worth $3 million. If we buy it, 300, I can find 300 if there's $1 million in upside. It's worth at least $3 million. We came in and we just proposed, hey, there's going to be no payments for the first 6 months. We'll do the down payment. I'm going to close it. Payments kick in 6 months. That allows me to barely break even on the property. What we did it on paper. In practice, when we came in, we raised the money. We did a few repairs, which is like swapping out appliances, doing front door. Like, we got started on the project. A lot of the non-pays started paying when we came in and just did the work orders. Like, we just came in and weren't slumlords like the prior landlords. People started paying. We got some units leased. This was on the back end of that 2019, 2020. I won't even say the word so we don't get flagged. But it was at that one date when that one thing happened, and we were all home. During that time, the housing authorities worked with people on past due debt. And so we came in and we got, for a ton of that building, we got 3 months of their past due and 3 months of their future rent. So we got 6 months of rent all in at one time, and we reinvested it back into the building. 11 months later, we got an appraisal for $4.1 million on that deal. I bought out my investors with a refinance at that time. My goal was to buy them out in 5 years. We had no trouble obtaining a bank loan. And so we came through, we got a bank loan. My investors were cashed out. I was stupid at the time. And I said, hey, I have a buyout option to buy you guys out at double your investment within 5 years. Don't do that in 11 months. Doubling someone's money in 11 months is basically the same thing as borrowing at 108% interest. That being said, the real estate paid us the entire time. My investors doubled their money, which was too much money for the amount of time that they had to hold in there. I got to keep the building. I took additional cash out and again reinvested it into the building. That is an asset that is cash flowed like $10,000+ a month. I have spent $0 out of my pocket. I got to keep money out of the refi, so I got paid to buy it within the first year. That deal by itself almost retired my wife, just by itself. And 2 weeks after that, I bought a seller finance 6 unit, and then 2 weeks after that one, I bought a 7-plex. Took 2 months off, and then bought a 12 and a 10. All seller financed. We built creative finance, or not creative finance. We built financial freedom through creative finance in a relatively short period of time. But that 38 unit, it was a hard project. The only difference between me and everyone else on that deal, because they were open in seller finance, it wasn't listed with it, but anyone could have asked. And it was only going to sell in cash or seller finance. There was never going to be a bank that was going to lend on that. We just asked, how would this cash flow? That's it. The answer was, they want $10,000 a month. I want cash flow. Property doesn't spit off $10,000 a month. How would it? I need 6 months to fix the problems so that I can afford to pay them $10,000 a month on the mortgage, which, by the way, it was 4% interest. It was almost all principal. So we're chunking down that principal a ton, and we're cash flow. It was a great deal. And all we had to do is just ask, okay, how do we cash flow it? And so that's how we came up with that structure. And there's been a lot of different structures, but this is the takeaway for listeners.
Yeah.
You're listening to this right now. It is not about being smart. It is not about being it's not being the cleverest investor. It's not coming up with this crazy secret structure. It is, what is the simplest answer to get what I need and give the seller everything they need. If you just wrote it on a whiteboard as like goalpost A, goalpost B, I need cash flow. I need to be able to hold this property forever. Seller needs $2 million, needs $10,000 a month. That doesn't cash flow. How would that cash flow? You find the simplest piece. I just can't pay the mortgage until we get there. That's what's killing this. Let's not pay a mortgage. I'll say yes to your price. I'll say yes to your terms. I'll say yes to your interest. I'll say yes to your payments. This is what it's going to look like. I'm going to give you a down payment of $300,000. That's not nothing. And I didn't have that money. And I didn't have anyone who I knew who had that money. I did have a deal, and the deal will always raise the money for you. We found the money. We closed the deal. We gave them everything they wanted that they've been waiting 12 years for. They just had to wait an additional 6 months for the back half of what they wanted. That was it. It is the simplest possible answer to what everyone else felt was a really difficult equation. And if you
Christian,
can come up with that simple answer, you're going to get accepted almost every time.
man, there's a lot of insights in what you just said. First of all, you talked about being creative on the offer. This was not some deal that you were cold calling. You didn't discover this thing, under a rock. Like, this wasn't some marketing strategy to uncover this opportunity. You just had a more creative view. And I love it. I used to work in advertising, and um, there was a quote, and I'm going to mess up the quote, but the point of the quote was, um, creativity is really being able to look at the same thing other people have seen, but seeing something different. And that's where imagination kicks in. And that's what separates those folks who are able to do creative financing and creative structures, because I'm sure hundreds, if not thousands, of investors have looked at that same exact deal over the last 12 years, but you were the first one to sit down and see something different and actually work through the challenges to say, okay, here's a problem, here's a solution that can help the sellers and help me. You talked about, going back to your principles, making sure that, you could cash flow out of the gate for a deal that had negative cash flow, which feels like an almost impossible scenario, but you were able to figure that out, right? You did that. You gave the sellers what they were looking for, which was a hefty down payment and also the $10,000 a month. And you were able to make this deal work. I also know that, and I want to go back to the challenge you mentioned, right? You didn't have the $300,000 yourself. Uh, if I understand correctly, you had done a couple duplexes, but not a huge background or portfolio to convince other people to invest with you. And you also were following that Dave Ramsey approach, was, about not using debt. So I want to understand how you were able to shift your mindset here, both from a debt perspective, and obviously this wasn't bank debt, but you were getting seller financing, and then also how you were able to get other investors to believe in your vision and invest the funds with you to take down this opportunity.
This is what I've learned is the difference between people who buy a lot of real estate and people who buy a little bit of real estate over a long period of time. If you start with the money, which is the temptation, right? If the goal is to build money, you're like, I'm going to close this deal. How do I know the money's going to appear? Right? If you don't have a lot of money, it's easy to get stuck and limited by the money. So, starting mindset for Christian. I can't afford a 38 unit. I don't have the money. I don't have access to the 300,000. But I've seen some episodes on Bigger Pockets and other podcasts where I understand there's low down ways to get into duplexes. So I can buy small properties and one day scale to large properties. I think that's the logical fallacy. That's the, hey, when I was in kindergarten, I worked really hard to get to first grade, then second, third, fourth, fifth, middle school, high school, maybe college, first job, second job, third job. We are trained to add little baby steps to get from where we're at to qualify us for where we want to be. I wanted to be a big investor. I was adding all sorts of extra steps to get there. So what I swapped from, instead of going, hey, I have X amount of money to use, and I'm going to figure out what deals fall into that box, that's very rigid. That's going to limit you to, if you're struggling to find deals, you're probably not looking for deals. You're probably looking for one certain strategy. I'm looking for things that I can buy FHA. I'm looking for things that I can do a BRRRR method on. I'm looking limited ideas. Instead, look for opportunities. So instead of saying, hey, I'm looking for the money and the money's going to tell me what deals I can buy, deal, then debt, then equity. And here's what I mean. A deal is an actual opportunity if someone wants to sell a property. You have a rough draft of at least this is what the property makes, this is what it costs to run, and this is what the seller would like to see happen. Actually, I'll throw out the word seller. They're an owner. Throwing out the word seller has been really great in my career. They're just another owner. You're an owner, they're an owner. I need to know what they want. They need to know what I want. That's the deal. So now there's an opportunity. There's a 38 plex, there's a 6plex, there's a 72 unit, whatever it is. There is now an opportunity that moves me forward and increases my cash flow on the table. What are the available debt products for this? It's not always seller finance. I've done plenty of deals, $0 out of pocket, with bank finance, with private capital. There's a lot of different ways to do deals without having money. I almost think of it like a computer screen where you just click the little down arrow and you just select the debt product that works best for that deal. What is available? Let's click one of those. The debt product you select is typically going to be 70 to 100% of the money for that deal, which means you could be deal debt done if you have enough cash flow in that deal and you can sustain the debt. If you answer those questions, how do you never lose it? That could be it. It could be seller financed, like that one, 15% down. Here's the difference of thinking of it that way. I have an opportunity that can make me $1 million. And it ended up making, $2.1 million in equity. Everyone can find $300,000 to make $2 million. Like if you're like, hey, I am highly confident that we're going to make $2 million, you will scramble and find that $300,000. I guarantee you it will come. And there is not a lack of people who have money who want to make more money in real estate. The capital is not the problem. When you go deal, debt, equity, take 3 as an example, found the opportunity, figured out what everyone wants. Debt product, seller financing makes the most sense. They want 15% down. The money I'm looking for is not $2 million of purchase. I'm looking for the last 15% of a deal where we already have all the goalposts. We're completely negotiated. We're under contract. We have most of the money. And so when I'm asking for capital, I actually found a broker who a friend knew. So it wasn't someone I knew, who specialized in duplexes through fourplexes. And I asked him, do you have any clients who want to buy bigger deals but do not have the opportunity? And he's like, I can think of a few people. He gave me 4 names. So I talked to someone who I didn't previously know, who gave me 4 names of people I also have never heard of. And I shared with them the deal and the debt that I'd already negotiated and my vision for the project. 3 of them said yes. The capital was raised in 1 day. I had never raised money before. I did not know these people. I had no experience doing this or no actual reason to believe it would work, other than I had an opportunity that I believed would make a lot of money. And I presented to people, this is why I think this is going to make you a lot of money. And you're backed by this real estate. And in the event that we fail, I'll also back you by my equity in this real estate. So we're going to partner in. You're backed by 100% of the deal. If I fail, you make more money. It's not a hard pitch to land. Money came in, and it has happened on every single deal. In fact, I run a mentorship group. Over the last 4 years, mentees have done a little bit over $100 million in real estate, which is super awesome to see done. No one has ever failed to raise capital for a deal. Deals fall apart for, the inspection, there's a foundation issue. There's the seller lied about I'm not saying every deal that's ever been accepted is closed. No deal ever has failed to have capital raised. There is more money than there is deals. But if you're coming in with an opportunity and a debt product, you've done all the legwork, and you're asking for that last 10, 15% of the deal, you're like, hey, I'm 85% done. Would you like to join me on the last 15%? That's not hard to do. Look at it that way, though. It's deal, debt, equity.
Deal, debt, equity. I think it's a great way of thinking of it. You mentioned that, with some of your clients and your mentees, you know, capital is not the thing that has caused deals not to work. And a lot of our listeners are in syndication and have capital raisers and folks in that space. And that is not the experience. When I talk to people that they see, what do you think it is about the way you're structuring the deal or conversations with potential or prospective investors that's different than maybe what folks are experiencing when it comes to syndicating for larger apartment deals?
So when we're raising capital, I've done every single deal has been done either individually or as a JV. I've done 0 down seller finance deals. Turns out you don't need a partner for those. But occasionally, if you don't have the money and the debt doesn't cover all of it, you need to bring in additional people. And I don't have anything wrong with syndication. I know syndicators who are very good at creative finance, who structure amazing deals, And the number of people that are on the deals merits the structure of syndication. Syndication is one of maybe 20 different ways that you can take out multifamily deals. Traditionally, if you're going to have more than 5 partners, syndication is usually, on even just an IRS level, the most correct way to do it, because I don't think you can make the argument that you have 6 or 7 active investors in a mid-sized. There's some tax code laws where syndication suddenly becomes more correct when you're gluing more than 5 partners to a deal. Is typically what that would look like. For every other structure, I've almost always found it much simpler to structure as a joint venture. And there's a lot of creativity that you can have in entity structure. The basis of it, though, I need to back someone by more than they are putting into the deal. That is, you need to answer 3 questions when you're raising capital. First, and this is 90% of it, by the way, what are we buying? People start with the numbers, and I don't know about you. Someone just like opens a presentation with a spreadsheet, I am just like completely zoned out. I'm like, wow, there's a lot of numbers. Start with the deal. Like, pull up a picture. I am buying this property, and this is why I'm excited about it. By the time, if you have an interesting project, like a 38, it's like, we've already overcome all the objections by presenting the project, right? There's a minor chicken infestation on the project. Someone is raising chickens in their unit, and they're everywhere. We know we have a septic problem. One of the 4 roofs is bad. Tenants aren't paying. There was a homeless camp on the back, but we got that resolved way prior to close. The neighbors and the city came in and helped us with that. The neighbors actually built this beautiful wall all the way around our property. They were a developer, and they're like, yeah, your property has problems. We're just gonna wall it off from our development. I was like, beautiful. They paid for it. When we came into that project, I was like, these are all the problems, and this is why no one's bought this. And here is how we are going to fix this, and this is why we're going to make a lot of money when this is fixed, and here is how I'm going to fix it. But this is why I'm excited about this project. For all of those people who I pitched, they were all people who owned duplexes or fourplexes. 90% of the deal is done right there because they're like, I want to be part of this project. Why wouldn't you? It's exciting. It's an exciting, big project. The other things that you need to answer is, how is their money safe? Which is more important than the last one, which is how they make money. That is where people get confused, I think, is people think, hey, I need to pitch people on how they're making money. That is the third most important thing of the 3 critical things you have to hit. 1, what is the adventure we're going on, and am I excited to invest in it? You invest in things that you are excited to be a part of. So when you present that deal, before you get into the numbers, people should be thinking, oh my gosh, I hope the numbers are amazing on this because I want to be a part of it. Like, I hope this is a great deal because I love the project. That is where people get sold because they want you to sell them now. Now, like, I want to be a member of this group. Then we get on to, okay, how are you backed? And so in that one, hey, we split the equity that 40% to me, and then the other partners all have the 20% of the deal. However, they're also backed by mine. In the event that I do not buy you guys out in 5 years, it's just an if-then buyout option. I will double your money within 5 years by buying you out. Or if I fail, you get my equity in this deal. And you guys get to take over the project. You guys can appoint whatever leadership you want, and I'm out. Which you guys would make, on paper, a lot more money. If I fail, you guys make more money. If I don't fail, everyone doubles their money in less than 5 years. This is great deal for everyone. And we all share cash flow in proportion to our equity. So as we got cash flow up, everyone got paid a little bit. It was a good deal, and it's structured in a very, very simple way. That is a great debt structure. There's like, we could do like a 3-hour podcast just on like creative entity structures. But since we brought up the 38, I was like, it's a good example of back them by more than the money that they're putting in. And then last, explain where the return's coming from, which is already laid out through the whole story that you told. Here's how you're backed. Here's the story. When we do this, we're expecting a valuation of this. Now you finally get to the fun part where you're like, now let me show you the spreadsheet. This is the numbers, and this is how we underwrote the deal. You guys are welcome to all of this information. It's all here in a nice little zip file. Um, by the way, sorry, I forgot to do this capital raise more than 2 weeks before we're closing. So decide quickly, and away we go.
Christian, I love it, man. You gave some really, really great insights, and some of it was a little more subtle. So I want to punctuate a little bit more. But in short, you talked about there being a couple things. One, focus on the story. What are we buying? What's the deal? Why is it a deal? What's the business plan? Let's get people excited about why this is a great opportunity. The second thing is people want to know, how their money is protected, right? You said safety, but ultimately, what's the deal structure? How's my money going to be backed? What's the security? Is there, let's call it competing interest, or are interests aligned? Do I actually make more money in case you fail? Like, those are the things where people want to see that you're properly incentivized to deliver for them.
Yes.
And when we do our syndications, a lot of folks will do like preferred returns, and it's kind of a similar metric. But the point is, investors want to know that you have a strong incentive to perform. And if
Yes.
you don't perform, it's going to suck way worse for you than it will for them. And that's going to make people more comfortable investing with you. The thing that you said, though, that you said it before this, but I want to punctuate it. You mentioned that the folks you were talking to were other duplex and fourplex owners. And I tell my clients the same thing. And it's when you're raising capital for deals, three things have to be true about the person you're talking to. One, they have to believe in the power of real estate to help them achieve their financial goals. If
Yes.
they don't believe in real estate, it's too far of a leap to even consider your deal. So they've got to believe in real estate, right? If they've had a terrible experience, or they're scared of money, or whatever it is, like, you're just not going to get them. But they got to believe in real estate. The second is they got to believe in your strategy. So in your case, when you talk about duplex owner, fourplex owners, smaller commercial multifamily is the next logical transition, as you said. So when you go to them with a 30 unit, okay, that feels like a stretch. That's probably a little too big for me by myself. But if
Yep.
I could partner with a Christian on it, okay, this is a great way to get into this space, right? So they already believe in real estate, they believe in the strategy. And now the third thing is they've got to believe in you and the opportunity. And when you structure the deal the way you've done, even if they met you that day, you're able to build a ton of credibility because they see the way you've structured the deal and they feel like their risk have been mitigated. Building the confidence in yourself, though, and that connection with individuals, that always takes some time for people to get comfortable. Not a crazy amount of time, but certainly, it takes time for most people. I know on that deal, you were able to talk to a guy you didn't really know that well. He introduced you to somebody else, and then ultimately you got investors through almost two different conversations or relationships. What did you do, or how did you position yourself as a credible investor to get those folks confident outside of the deal structure itself?
I, I get that question all the time. Like, when I'm on podcasts, people, how do you practice this, or what? How does the pitch go? I didn't. The deal just sold the deal, and I found this has always been consistent for me. And granted, I'd mentioned I had an 8-year sales career, so there is an argument to be made that I had some of these soft skills to, already developed. But I have found that if you can just talk about the things that you're excited about, and you can articulate them in a way that makes sense, there's there's not a mystery that real estate makes people money. Like, real estate is, generally speaking, considered the most consistent way for people to build lots of wealth. Like, that has been forever. That is kind of like a common knowledge thing. Like, oh yes, if you hold real estate for a long period of time without losing it, you become very wealthy. People generally get that. It's not hard to get people excited about making money in real estate. If you can present a plan that makes sense and you're sincerely excited about it, I've never seen anyone fail to raise capital. It's there is too much money, especially right now, but there's just too much money in proportion to opportunities. We have a shortage of housing in the US. We do not have a shortage of printing money. We never have. There is lots of dollars. There's lots of people with too much money. And over the last 3 to 4 years, we've seen really low deal velocity, which
Yeah.
means people who want to buy deals, there's less opportunity for them to invest in a great deal. So it's been really easy the last several years to raise capital. But generally speaking, those rules are always the same, because when it gets, when there's more deals on market, real estate's also considered sexier, and it's like, there's never a reason not to invest in a great deal. I just always start with the opportunity. I think where people have had trouble raising capital is they try to raise capital before they have the opportunity. And if you don't have the experience, you end up just kind of looking like a novice. You look like a noob. And when you come in and it's like, hey, I'm going to be finding a deal and I'm looking for people who are interested. And when you generate all that interest before you've done anything, you just look like another person who's watched too many YouTube videos on how to buy real estate. Or you look like someone who's taken some really lame online course. Something it is usually what I see. It's usually young people, and they're usually trying to get in front of you to pitch what they're going to do. When you have an opportunity under contract and you have a debt product that makes sense, I don't want to say the money raises itself. There are some soft skills involved, but for the most part, just say the things that are true about your deal and your plan. Capital comes in. I've never seen an exception to that.
Yeah. I think you hit on some really, really great points. I do want to give the context of, for you when you're talking about the deal size, the structure, the types of investors you're talking to, it makes complete sense because again, these people, they're actively looking for deals, right? So if you're already a real estate investor and another real estate investor brings you a unique opportunity that again is a little bit bigger than maybe what you can do by yourself, that's going to be attractive. I think the mistake I see a lot of people make is they're talking to people who are not real estate investors.
That's
So you're,
crazy to me.
when you're talking to an attorney or a CPA or a doctor, and that person has legitimately never thought about investing in real estate, not legitimately, and you're talking to them about a deal, well, they have such a longer learning curve of real estate and the risk that it's a little harder. And then to your point, they need to see a real deal to be able to react to. So it's a little harder for that person to understand kind of this theory or this notion of what it looks like versus what you're doing is you're bringing a real deal and you're saying, hey, I got this deal and we're going to move fairly quickly. And it's a great opportunity. And it's easy for someone to get on board, especially if they already have some of those boxes checked in. Because to your point of the soft skills, from that sales background, there are things that I'm sure you can pick up on in conversations that, someone who's coming from engineering as a background, probably they may not have those soft skills, right, to understand it.
Sure.
However, I think to your point, when you have a great deal, that's going to do so much of the heavy lifting that people are willing to forego and forgive whatever soft skills you may lack as long as you've got a great deal and a great plan. So I just think it's really, really important. A great point that you brought up there.
And I've noticed the engineers tend to be quite good at doing the deal architecture piece. That seems to go hand in hand. So it's not a hard pitch to be like, hey, maybe I'm not the best presenter of all time, but uh, I'm an engineer, and our structure on this deal
Yeah.
is pretty genius. And it's like, oh, I feel bad. They must be good at structuring deals. They're an engineer. It makes sense. The story just has to make sense, and
Yep.
it has to be true.
Yep.
But if you have a real opportunity, so I guess that's the skill to build is if you are newer to buying larger buildings, be confident when you are looking at a deal that it is a deal. It does not take that long. We don't go beyond algebra 1 in real estate. It's like NOI divided by cap rate equals price. I mean,
Yeah.
there's not a lot of complex equations in real estate. It's really not very hard. You need to know when I'm looking at a deal, does it cash flow? Can I hold it? How do I buy it? How do I lose it? If you can look at a deal and you can confidently mathematically say, yes, this checks the boxes, raising capital should not be that hard. If you want a cheat code, by the way, for finding deals and for raising capital, I right on for like, yeah, I'm not looking at doctors or lawyers or anyone else because I'm like inherently they believe in going through the step-by-step education system to get a high income job. They're actually probably the opposite of the mindset of let's go on an investing adventure. Some of them do become great investors, but for the most part, these those are like the people who are the definition of I went to first grade to get to second grade to get to college to get to my next college to get to pass the bar to do like they are going to add more qualifications to themselves to invest in a deal. What I am always looking at is like, who's the most likely person to buy this? I have found more than 50% of my deals doing this. And this is also more than 50% of my capital. when I enter a market. I started in Moses Lake, Washington. I've since moved to Dallas, Texas. I own in 5 markets down here, but the main one I invest in is Stephenville, Texas. Little town, but if you include the whole MSA, it's probably 90,000 people. Booming college, apparently fastest growing college in the U.S. now at Tarleton State University, an A&M school. That little great town only has so many significant players. You go out and you meet the people who are already buying all the real estate. It takes about 30 days in a small to mid-sized town to get coffee with everyone who owns a significant amount of real estate in that town. It's not very hard to do at all. You move from being an outsider to an insider. If you go to sell a property and list it, you have to pay fees to a broker. There's a whole bunch of extra. Everyone always reaches out to their friends and relationships if they want to sell a building, or if their friends want to sell a building. It trades off market so often. If you have a sincerely good deal, why would you need to list it or pay someone else to sell it? If you have an opportunity, you're like, hey, let me call my friends first before I list it. I make sure that everyone in my market just knows who I am. And that is getting coffee with owners, not looking for sellers. To date, I've never asked anyone to sell a property, ever. It has always been their idea. Always. I mean, granted, sometimes you call it an on-market listing, but even then I don't ask them to sell because it's kind of implicit that, I'll ask questions about the property, but you never come in. Would you sell this? Of course they'd sell it. It's listed. For the other ones, they propose to me, hey, I'm looking to off this building, or I have a friend who's trying to off this building. I know you don't have a lot of cash right now because they know me. And so they're like, okay, I know you don't have a lot of liquidity right now. I had an idea. I think we'd be willing to carry a contract. This is what it would look like. And now we're doing that mapping of my goal, their goal. In addition, if you know everyone who buys real estate in that town and you have a great deal, guess who's really likely to invest in real estate in that town? The people who already do that all the time. A lot of the people who are farther than me have been the people who have funded my deals. I come up with a deal that I'm like, I think this is a great deal. And I'll call them and I'm like, I just got this under contract. This is what I'm working on. And half the time they're like, oh, you got to be kidding me. I didn't know they were selling. I would have bought that. I'm like, well, great news. You still can. This is what I'm working on. I will need to bring in an additional capital. This is the structure that I was thinking would probably, and now you're negotiating for capital. That is way better than a doctor. And they're going to be your best deal source. And they can refer you to the best property managers, the best lawyers, the best CPA. Like, they've already built the business you want to build. And because they did that, they usually also have a lot of money. Like, the people who've already succeeded. That's why I don't go after distressed properties. Granted, the 38 was distressed. But most of my deals are nice, already stabilized properties. Buy a lot from people who are, they're winding down their portfolio or they're scaling up their portfolio. Mid-sized multifamily tends to not be the asset that people pass to their kids. I've noticed. You either scale up to like 100 plus unit, that's more passive, where you have on-site everything and it's its own contained business, or you sell the property and give your kids cash, or you sell or finance your portfolio and you give them notes. Like, you don't typically pass your kids who are not in real estate a 50 unit building and be like, hey, don't screw this up. There's enough technical knowledge where estate planning typically requires, I need to either get rid of the big stuff or I need to buy something really big and then 1031 into that and pass to my family. Those are the exit strategies. So I get a lot of people in their 70s and 80s saying like, well, I wanted to pass this to my kids. Turns out it was really hard for me to get there. And they saw how hard I worked and they want nothing to do with this portfolio. However, I see myself in you because we've met for coffee 7 times. You've asked great questions and we've spent time together. What would it look like for you to take over my empire? I have had 2 people in my career who've built multi-100 unit portfolios call me and say, hey, I love working with you. We've maybe done 1 transaction before. What would it look like over the next 5 years for me to sell or finance my entire portfolio to you? My kids don't want it. I trust how you operate. That is there are no secrets in real estate. It's, it's been around for a while. But that is the thing that I think a lot of people do miss. That's the secret sauce, is if you can become an insider, and you don't need experience or all this stuff to be an insider. If you can sit down with people and treat them as an owner, not a seller, you can, absorb people's entire empires. And they can do it multiple times. You could become a titan over coffee, which has been my model. I don't prospect. I don't pay for leads. I will look at what's listed probably once a month, and I'll make a couple calls. I write up to 2 offers a month. I only write offers that I think will actually be accepted, that have had conversations around. I'm not shotgunning offers. I hate letters of intent because when they get accepted, I'm still not under contract. I like offers better than letters of intent. I'd rather discuss and say, yes, we like this. I don't have a lot of steps to my process. I don't have a team. I never have. It is Christian getting coffee once a weekend. And in a year, I will meet, well, once or twice a weekend, I'll meet 52 to 100 owners every single year. And I'll maintain those relationships. And I'll talk to people about what I'm passionate about, which we're real estate guys who talk about real estate. And that is taking care of all of my deals, all of my capital, all of my relationships, my entire business. I own a property management company. I have like 3 employees in that team. Like, I run a super lean ship with no paid advertising, no leads, and infinite capital over coffee. It is, I haven't done a lot of things really genius in my life, but I love that business model because I legitimately did not give myself another job in real estate. I gave myself a really intense hobby, and I love doing it, and it's just not work. I'm not cold calling. I'm not ripping through just all the things that you think about when you think starting a real estate business. I don't do any of them. In fact, I usually don't take meetings before 9. I saw this on my calendar. I'm like, what am I doing? Why did I say yes to this? I should have said do this later. Generally speaking, I stayed on West Coast time when I moved to Texas. I work late at night, and I have the privilege of sleeping in every morning. I built a business. It's definitely not passive. Real estate's not passive. But I built a business that's not that active, and all the active pieces I do are really quite fun. That's the whole business model. If anyone's thinking about getting into this, it is easier to raise for a bigger deal. No one wants to get excited, in my opinion. No one gets excited about investing in a duplex with you because they could just buy it themselves if they have the money to fund you. People get really excited about larger projects. And
Christian,
so,
I love everything you said. Sorry, I want to jump in, man.
no,
You said a couple things. I just want to
you
recap.
got me on real estate, man. I'm
Yeah,
gonna
man.
just
No,
keep
you were
talking.
flowing, so I was letting you cook, man. A couple things you said, man. I just think it's really great, and I want to just ladder it up because there are a couple themes that I think are really resonating. First and foremost, you talked about, and you said it, when you're talking, you like to focus on owners, not sellers, right? Like, these are just other owners. And you talk about building relationships and building rapport and sitting down for coffee every weekend. You're building real relationships. And I think that's something that people overlook. It can be very transactional, right? We've got this broker. This broker is going to sit between the buyer and the seller and help this transaction and help us, work through it. You're like, why? Like, let's just be owners. Let's connect. Let's do deals with friends. Like, if they know me, like me, trust me, they'll want to work with me when they're ready to sell. We know that there's an aging population that has developed these portfolios and they're looking at their kids, and the kids have no desire to take it over. So yes, they are going to be sellers. And this is going to happen all across the country for the next at least 10, 15 years. So positioning yourself to be that solution is a great way to increase your deal flow without having to rely on cold calling, prospecting, sending out a bunch of offers, building solid broker relationships, which there's nothing wrong with that. But you've got a strategy that is really built on building relationships and it's funny because you come from the sales side, but you're not doing the typical sales things to build these relationships. So I just love the fact
Exactly. I
that
wanted to
you
get out of the
have a
sales job.
great approach.
Yeah, that's the thing. It's like I did not want another sales job. I already have that skill.
Yeah.
I can already go out and earn money. I want to point out, I used in my 20s, I still bought a house and a couple duplexes without partners. It's not nothing. Like, I know that I can sell and earn money. That was not what I was going out to prove. I wanted to see, can I leave a sales job and not have to do that piece?
Yeah.
Sure, there's sales negotiation involved in real estate, but it's just not the same. It is much, much different. You are creating your own product. You are negotiating your own deal with pretty simple, basic math. And then you're going out and you're executing on a plan. It is not a sales and marketing job, and I don't think it should be. I would not trade my job at the CoStar Group to go dial houses. I'm like, I sell data to these people. Why would I? I'm not going to go.
Yeah.
I'm not going to take their job. Their job is, they come to me for the information. This is ridiculous. That'd be a step backwards in my mind. I was making pretty good money at the CoStar Group. I did well in sales. I wanted to create the life that I wanted. And the life that I wanted, I actually wrote it down in one sentence. This was what changed, by the way, from duplexes to multifamily. I wrote down one sentence, said, I need to create $15,000 a month. So I mathed out what does freedom cost me. For me, it was $15,000 a month to move to a warmer state in a bigger house. I've never had a big house before. I came from the low end of middle class. To have a big house to be able to start a family. So but those are expensive, large mortgage, start having kids. Those all cost money. And retire my wife. And for me, $15,000 a month pays for all that. And well, it does in Texas. It would not be a large house in Washington State, but in Texas, that gets me to where I want to go. So I live where I want to have. I started my family, but I had a very specific goal that was quantifiable. The one sentence is I need to get $15,000 a month through real estate in the next 2 years so that I can retire my wife, own a bigger house, start a family. One sentence. That one sentence, while I'm not like a motivational speaker or vision board sort of person, I'm not. I did write down that one sentence, and that one sentence got me to 15,000, and then we doubled it, and then we kept scaling. You set new goals when you hit your goals. But having a single one sentence that defined what I'm doing, what it costs to get there, and how long I have to get there is basically goal setting 101. Funny enough, covered in Dave Ramsey's book. I started on the Dave Ramsey method. I ended up on the Kiyosaki side of things, but there are some principles in there where it's like the way that I save reserves pretty much follow Dave Ramsey method. Like, hey, let's take total expenses and let's make sure we're set for 3 to 6 months on every property in reserve. Great principle. There's some great principles in there. Yeah. I don't like anything with the word baby steps because my goals are bigger than taking baby steps. I would like to sprint to where I'm trying to go. But outside of that, like, that's the model. Know what you want to do and then just build a path to get there and then just go out and do it. It's not, I don't know, real estate's just not very complicated, which is why I like it. It's work, but it's very simple. It's not easy. It is very simple. So you don't have to be very smart like me. You can just kind of just do your thing and get coffee and you look back and you're like, wow, we have significantly more millions of dollars than we did when we started this. I don't feel like I've really done work, like gone to a job in a long time.
Well, I love the way you've approached it, right? You put yourself in a position to have that flexibility. You started with that vision. And even though you weren't the vision board guy, you wrote that sentence and you gave yourself clarity, and you've done an excellent job of executing that. For folks who've enjoyed our conversation, you want to check out Christian. He's got his own podcast and he also has a YouTube channel. So check out the YouTube channel. It's Multifamily Strategy on YouTube. Great content there. So please be sure to check him out. We'll make sure we put a link to that in the show notes as well. Right now, we're going to transition and go to a round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the mastermind button today. Christian, give me a failure or an apparent failure that sets you up for later success.
Oh my goodness. Okay, so when you make mistakes, keep your mistakes to less than $4.5 million. I will start with that. That's the punchline. I also know this is a lightning round, so I won't go into super long stories. I made a mistake of identifying myself as a creative finance real estate investor. I am not. I am a entry-level housing expert. I'm really good at renovation. Anyone who heard slumlord there, think the exact opposite. I am really good at renovating, providing excellent housing to a niche of people who need excellent housing. I am also good at creative finance. I am not a creative finance real estate investor. I am an entry-level multifamily investor who is able to get creative. I bought a resort for $4.5 million, seller financed, 4.5% interest. Just a awesome deal structure. Low interest, seller finance, knocked it out of the park. Problem, having a resort has there's 8 employees, 11 in the summer. It's a small resort, so it always needs active management. And I put all of my multifamily players on that LLC. None of them did any work. I had the wrong partners. I had the wrong structure. I borrowed the down payment, which was $1 million, and no one helped with the project. So over 3 years, it's been my wife and I running a resort by ourselves while we only have 20% of the equity and floating all of the renovations because all of my partners ran out of money. That is, I can't even have a full podcast to explain all the things that we didn't do right on partnership structure, on purchasing. But the biggest mistake was I did not identify what my business is. And so I took a lot of time that got sunk into making a project work. And on all of its merits, it makes money. We did a good job running it. It takes an unbelievable amount of time and energy out of my businesses. That is a job. I bought myself a really, really, really hard job with a small resort, and I have no business in being in resorts. That was the most expensive lesson. I bought it for $4.5 million in my first year of real estate. That is my stupid tax. It is awesome. On the water, in the forest, there's hiking, wineries. We have kayaks. There's a river that runs through the resort, 13.5 acres in the Olympic Mountains. On the Hood Canal, you could watch orcas from some of the cabins go through the canal every few years. It is amazing. That is not a reason to buy it. That is a $4.5 million shiny object syndrome when I had a net worth of $900,000. That was dumb. That was super dumb. If I could go back in time, I would have 2 or 3 times the multifamily portfolio I have, because I wouldn't be at a resort trying to fix a roof myself. That was so stupid.
Definitely
Don't
a
get
life
distracted.
lesson there.
Understand who you are. I'll answer your other questions more succinctly. That one is
I appreciate it. It's a great reminder for all of us, right? Just know what works for you and try to stick to that.
Visit my resort. It's beautiful. Robin Hood Village Resort. Also, right. Don't buy it unless you want it, in which case I am open to an offer. I don't want to manage this thing, but it is amazing.
All right. Give me a digital or mobile resource you recommend for our listeners.
Digital or mobile resource outside of my YouTube channel, Multifamily Strategy, which has 2,000 videos, finally over 100,000 subs. I'm excited about that. Mobile resource. There's 2 books actually. And neither of them are on real estate. Never Split the Difference by Chris Voss is my favorite book on negotiation. If you can negotiate, unbelievable insights. Love Chris. Jordan Belfort, Straight Line Selling. Most important piece of it has to be audiobook, which is why it's a mobile resource. He has a chapter in there on tonality. There's a bunch of other great insights in there. You cannot read a chapter on tonality. It does not work. You have to have the audiobook because you have to hear the tonality. He talks about just a few different ways to inflect your voice when you are talking to generate interest. It has been the single best negotiating tool that I have. And it's as basic as learning, when do I use an uptone and a downtone? You can absolutely control conversations with the information in that book. Those 2 books got me to where I need to be on sales negotiation so that I can focus the rest of my time on coffee meetings. Those 2, have them, download them, listen to them on audiobook. Great resources.
There we go. I love it. Well, you hit the next question, which is going to be what you recommended the most. So that's great. We'll take that one. Give me a daily habit that helps you stay focused on your goals.
A daily habit, I break down all of my tasks because, again, I'm not a super details person. So for me, I have to do something that's sustainable. I have all of my time blocked by task. I have 4 main companies. If you don't count the resort, then I guess I had 5. I have a lot of tasks. I have color-coded blocks for this is when I'm working on this thing, this is when I'm working on this, this is when I'm working on this. It's flexible what I do in those times, but my time is scheduled for this is property management time, this is deal acquisition time, this is my time set aside for my mentorship group and my mentees, which is a huge portion of my time. But these are the dedicated slots. tasks within those slots are color coded by this makes me money now, which is green. Yellow, this is important and it will make money in the future, but it may not make money right now, which usually comes after the green task. And then there's red tasks, which are, they do have to be done, but they are non-income generating tasks, and they are usually the ones where there is a way to delegate this to someone else. I would rather focus on the things that bring in money now and bring money in the future, because that pays for me not to have to do the things that are in red. So I actively, at the end of the day, review the red items and I go, could this have been avoided, delegated, or is this just a task that Christian has to own? And I do have, there's things that you have to do as an owner that have to be you. But I always go through that cycle for the red items. Is there a way to bypass this, systematize it, or delegate it? That habit of doing that every day, I've always worked 12 to 14 hours a day. I'm also a workaholic. I have no hobbies. I play the guitar. My hobby is real estate. Like work is, I love what I do, so I do it all the time. But I do not get burnt out on a 14-hour day of doing all of the things that I need to do for all of my businesses, because I'm working on tasks that move me forward. The best thing that I do.
Give me your number one insight for creative financing or creative deal structures.
It comes back down to what it comes down to. Do not focus on the money first. Focus on the deal. Deal, debt, equity. How do I own it? How do I never lose it? I mean, if you just go through that cycle, you have a deal. Go out and close it. That is, do not complicate it past that. Don't add steps. Don't skip steps. And mentorship. I've had a mentor who taught me how to buy a lot of real estate creatively, who lost his portfolio 2 times over because he never did that how do I keep it thing. He just goes, we could buy this. I'm like, moron. How do I buy it? How do I never lose it? Deal, debt, equity. That is the takeaway for everyone. If you just follow that, you will buy roughly infinite amount of real estate.
And Christian, let's go in a little bit of a different direction. You're in Dallas now. I know you spent a lot of time in Seattle, so I'll let you pick the market and location. But give me your favorite place to grab a bite to eat.
Oh, okay. I've had a lot of barbecue, and I love barbecue, and I love smoking. Love smoking meats. Love doing that. And I have a whole setup in my house. That is a hobby, but the nice thing is, it takes a lot of time, so you can still be working and smoking meat. Hutchins Barbecue happens to be very close to my house in Dallas. I have had a lot of barbecue. People say the best barbecue is in Austin. I have tried so many places in Austin that are amazing. Nothing is as good as the original Roy Hutchins Barbecue. It is ridiculous. If you're in DFW, it's like 20 minutes from the airport on the going west side. So it's on the Fort Worth side. It is so good. Hands down best food. Hands down best food.
Right.
Owner's a great guy too.
Sounds like a great place, and you've obviously tried a lot of different options there, so it comes with a high recommendation from you.
And we followed the rules. I know the person who owns the business, and I know the guy who owns the building. I have had barbecue with both of them. Do the owner meeting.
I love it. I love it. Christian, you gave some great insights, man. I really enjoyed our conversation today. You know, listening from your journey and kind of your mindset shift, going from the Dave Ramsey approach, buying all cash for these properties, to recognizing that, hey, there's a way to get into these deals but still minimize leverage or your exposure by focusing on owners, right? Building relationships, not necessarily sellers, but owners, and being creative. I love you talked about, you know, the deal, the debt, the structure there, and then the equity, and making sure that we are talking to folks who already are interested in investing in real estate. Just makes it a little bit easier as opposed to going the other way around, where you're talking to people, you don't have a deal, you don't know if they even like real estate. You're going at it in a way where you can be really efficient and really leveraging your time in a more productive manner. So love the insights you shared there. For folks who enjoyed our conversation, I implore you to check out your podcast as well as your YouTube channel, Multifamily Strategy, which we will link to in the show notes below. Christian, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.